All right, we're going to do exercise 17-2 on page 1043 of your textbook. And this is talking about what happens when a deferred tax liability reverses. Now, it's important that you are aware of what's already happened in the past in order to do this, because and as we go through and I start to make these journal entries, I'll point out the difference as if there were zero in the deferred tax liability account versus what they have currently in this one of 192,640 balance in the deferred tax liability. So what we've got here is an asset that has been depreciated for 4 years, and there are book tax differences because of the accelerated depreciation that they use for tax versus the straight line depreciation for the book purposes. So in this case, in year 5, our tax depreciation, so we'll just mark that as year 5. In our tax depreciation, we have $345,600 of depreciation. And for GAAP depreciation, we have $500,000. Now, I've reversed this from the last exercise. I put tax first in book. In the previous exercise, I put book first and then tax. It really doesn't matter which one goes where when you're doing the calculations. It does matter when you're doing the journal entries, right? So what we need here is the difference. And so the difference will be 154,400. If I got that right. Let me check it real quick. $154,400. That is correct. And then we multiply that times the tax rate, which is given to us in the problem as 40%. And so when we multiply that out, we get 61,760. All right. Okay, so that's going to be our difference. On that. So now we need to figure out our income and our tax and expenses, right? Okay, so the income before tax and depreciation is $850,000. And we have, for tax purposes, we have the same 345, 600 in depreciation, and for book purposes, we have the same 850 minus the 500,000. So that gives us 350,000 there. And 304,400. Again, we multiply both of those times 40%. We get 121,760, and we get 350. Well, that's a mistake there. That's 850. That should be 504. and that would be 201,760. All right, that's correct now. Then we take the 350. We have the 140,000. See what happens when I don't have you in class to check my math. All right, and so as we see, we have the 61,760. That's the difference here between those two. So now our journal entry will be tax expense. And this is the tax expense that we report to investors. And that's this number, the 140,000. And we have taxes payable. And that's going to be the 201,760. All right. Now, if this were year one and this situation existed for some reason, I don't know what that would be, but if this were year one and that situation existed, this entry on this line would be deferred tax asset. But because we already know from the problem that there's 192,640 in the deferred tax liability account, and that this is reversing that entry, we're on the other side. What actually happens here is we deduct the deferred tax liability, and that'll be the 61,760. So be very careful on this. Be very careful to know whether you're starting or increasing a asset or liability, or if you're reversing an asset or liability. It's very important because it determines what the journal entry account will be. All right, that's it for 17.2.